Yesterday, silver lost $45 in 6 hours, from 120 down to 75. That's a 35% collapse in a single trading session. If you're sitting there watching your portfolio wondering what just happened, I'm going to walk you through the real story. Not the sanitized version you're hearing on financial news. Not the oversimplified explanation from analysts who need to fill airtime. The actual mechanics of what triggered one of the most violent moves in precious metals history. Because here's what's strange. While silver was dropping 35% on your screen, something completely different was happening in the real world. Demand for physical metal spiked. Dealer traffic crashed websites. Wait times for coins increased. The paper price said silver was plummeting. The physical market said the opposite. One of these is real. One of these is fiction.
Friday morning, January 30th. Last trading day of the month. Silver opens at $117 per ounce. Not the high, but still elevated. Within the first hour of trading, it drops to 105. By mid-morning, 95. Early afternoon, it touches $83. That's when some traders started to panic. In 6 trading hours, $45 evaporated. But here's what makes yesterday different. The speed and the violence of the move. Markets don't usually drop 35% in 6 hours without a catalyst. War breaks out, banks collapse, governments fall. But yesterday, nothing happened. No geopolitical event. No financial crisis. No emergency Fed meeting. Complete silence from major news outlets until after the crash. So what actually triggered it? The explanation you're being given is profit booking. Traders cashing out after an extended rally. On the surface, that sounds reasonable. Silver did go parabolic this month. From 41 to 121 in 30 days. When price moves that fast, corrections do happen. People take money off the table. But real profit-taking is gradual. Different participants exit at different levels. What happened yesterday was instantaneous. Everyone's selling at once. The second explanation being pushed is the dollar. They're pointing to dollar strength as the trigger. But look at the math. The dollar index moved roughly 2% higher, producing a 35% collapse. That relationship doesn't hold. That kind of imbalance doesn't come from currency alone. Something deeper was already under pressure. Earlier this week, a nomination was announced. A potential new Federal Reserve chair, known for being hawkish on interest rates. Markets interpreted this as a signal that rates might stay higher for longer. Why does that matter for silver? Silver doesn't pay interest or dividends. When rates are low, nobody cares. But when rates are expected to rise, the opportunity cost changes. Do you hold metal that pays 0 or bonds paying 6%? That comparison shifts capital flows. Money moves into bonds instead. This shift didn't cause the crash by itself, but it created a fragile environment where leveraged positions became vulnerable. Add that fragility to a leverage cascade, and you get yesterday. A sudden, violent release of pressure. But here's what doesn't add up. If this was just rates, why was the move so synchronized across every exchange? While silver was crashing on the futures exchange, physical dealers were reporting something bizarre. Traffic to bullion websites spiked. Orders jumped. Premiums over spot price didn't collapse. In some cases, they increased. Think about what that means. The paper price dropped 35%, yet in the physical market, buyers showed up. They saw a buying opportunity. This reveals a critical split between the paper and physical markets. There are 2 very different games being played. There are paper derivatives and physical coins and bars. They should be linked, but yesterday, they diverged completely. Paper said 75, but physical buyers saw a discount. The paper market is massive but thin in actual metal. It's a betting market for speculators trading price movements, not a market for accumulating the metal. That's the real story. Zoom out for perspective. 1 year ago, silver was at $26. Yesterday's close at 75 is still a triple gain. Even after the crash, January was silver's best month in decades. Does this mean an immediate recovery? Maybe. Or price might chop around. Or physical buying could push it back up fast. What I'm watching is whether paper and physical markets reconnect or keep diverging. If physical premiums keep rising while paper stays suppressed, the pricing mechanism is breaking. At some point, one market has to give. Paper can't suppress physical reality forever. This raises a question. Why are some large banks floating scenarios of $50 silver? Is that a forecast or a stress test for what happens if leverage unwinds further. Stay focused on the physical reality. So where does this leave you? If you're holding physical silver, yesterday was painful, but it doesn't change your position. You still own the metal. The thesis of growing industrial demand and constrained supply remains intact. As of right now, that hasn't changed. If you're trading with leverage, yesterday was a brutal reminder of the risks. Liquidations destroy accounts on the way down. If you're thinking about buying, the question is whether 75 is the floor or just a pause. Nobody knows with certainty. Paper markets can be manipulated by leverage, but physical markets respond to reality. Yesterday was a paper event, not a collapse. If this helped you understand what actually happened, leave a comment and subscribe for more analysis.